Ladies and gentlemen, welcome to Woodburn Accountants and Advisors China webinar series on managing your accounting and tax in China. You have joined us for day 3, part 3, where we will be looking at how to avoid a tax audit for your China business, providing tips and advice on how to improve your daily accounting and operational procedures. The whole point of this week's webinar series is to give everybody insight into the accounting and tax world within China. So everything from profits tax to VAT to tax audits, implementing internal control systems, and then last but not least, developing repatriation strategies, which is ultimately a tax planning strategy to develop. So as we usually do with all of my webinars is I try to gauge who is in my audience. Now, for all of you who are attending live today, I am familiar as to who you are. So I want to go into detail, but this is more for those of you that are watching through the YouTube channel. Usually I separate attendees by their status in China, whether they are newbies that have found an opportunity or looking for an opportunity and they're trying to gain a certain level of education and information, to startups in China, meaning companies that have either implemented recently structures or companies that have been transacting with China for a certain period of time. Usually my time frame is 1 to 3, 1 to 5 years, and their focus has been fundamentally on the revenue aspects of their business, focusing on sales and obtaining income versus the actual internal control systems that have to be built up. And then obviously the experienced China hands who've been in China for probably over 10, 15 years and are just trying to get a couple of insider information into how things are working in China, if there's anything that's updated or fresh ideas that can be passed on. On Monday, I was talking to the audience about who were finance managers and non-finance individuals, and the outcome is really that it's 50-50. So I'm going to try and keep things as simple as possible. In today's webinar, I do have quite a few case studies I'll be highlighting, but it will be a lot of reading from the presentation to make it clear to you all how things work in terms of the tax audits. Again, this is 60 minutes of your time spent. Use it wisely. There hasn't been too much interaction in the last few days. So again, you know, the best part is usually the Q&A when everyone brings in questions. Use that time wisely. If you know there's no dumb question, ask away. But my main goal here will be to educate you on everything around tax audit. And who am I? My name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. I've got 17 years of corporate services and compliance experience in the Chinese market, based out of Shanghai. And my focus has been purely on inbound investment into China. I'm also a creator of the China Roadmap methodology, which is a step-by-step plan guiding people through all the back-end administrative compliance work that they have to think about when operating a company in China or just simply operating in China. It is a webinar that basically crosses the T's, dots the I's, and gives you all a checklist in terms of what you should be doing to protect your business and your assets. So if you want to join, that will be the last webinar I do in 2020. That's on the 8th of December. And if you want to register, you can go to our website. I'm going to add that in again into the chat section of the control panel. You can go to our events page on the website and subscribe for that. So to start off today's session on how to avoid a tax audit in China, we are going to look first of all at the risks of accounting or the accounting practice in China. So first of all, just to highlight, you know, receiving a visit from the tax authorities at your office is never a pleasant surprise because they are probably there because they've either found something or either your company has been denounced to them or whatever it might be. But when they do come, you have to be prepared in your mind frame that they are going to go through a very thorough audit exercise to basically check that your company is in a good standing and is in compliance. And let's face it, like I highlighted yesterday about fapiaos, VAT invoices, there's always human error, okay? I mean, you know, even the most honest of businesses, people make mistakes, and we have to be prepared for that. So whether it means that fapiaos have been wrongly created with wrong data, or there isn't supporting documentation available for transactions, you know, these things sometimes happen, right? Because not to your fault, could very well be that the third parties that you're collaborating with gave you fake documents, didn't give you enough supporting documentation, or they're delayed in providing that information to you. And then also in relation to the fapiao. So, you know, these human errors do occur. What we want to do is try to minimize that as much as possible. If the tax bureau is seeing that on every single month you are having to cancel and reissue fapiaos, or that with certain transactions you cannot provide the supporting documentation, and it becomes a real consecutive occurrence, that is a red flag. That is simply a red flag. And either you really have an unqualified accountant on board, or there is some cheating that's going on under the table, all right? So we do want to aim that you have a complete and as accurate as possible set of books that are according to PRC GAAP, okay? And the reality in China is the following, and this happens quite often historically, is that many businesses always kept two sets of accounts. One given to the tax authorities, and one that was a true reflection of the status of the company. Those times are gone. There is too many tools that the tax bureaus are now utilizing that make them quite advanced in their systems to allow you to have this two sets of book concept, where the one that you're giving to the tax bureau hides a lot of things that is occurring compared to the other set of books that is only kept internally, okay? So, you know, I've written here very kindly that it could be because of poor quality accounting or negligence, but there are many companies that do that actually on purpose, okay? And I just want to highlight here, we should be avoiding that. That's one thing that we really, really want to avoid, okay? Because having these two sets of accounts obviously just gives you greater risk in terms of getting a tax audit. It just means that your books, you know, are just not justified. Even the second set of accounts might not be 100% transparent. And ultimately, if you start going through the tax audit, or you have to provide additional documentation and come up with that documentation, that's all time consuming. It is taking all of your concentration and focus away from what it should be, which is the growth of your company and your business, okay? And one thing that I want to highlight is the fact that now there is this whole concept in 2020 about the credit level of a company, a credit level of an individual. So if you are going through a tax audit and it's not going well, then your credit worthiness could go down from being an A to a B to a C to a D, okay? And that just basically highlights that your company is not in good standing. Now, obviously, to avoid these repercussions, I have a commandment that I use. One of them is knowledge is power, and the other one that I use quite often is prevention is the best form of protection, right? So what we want to do is make sure that your Chinese entity is following PRC GAAP regulations, they're following tax regulations, your accountant or your outsource provider is getting updated on an annual basis in regards to all the latest tax regulations, if there are any updates, and then making that connection whether those new things apply to you and your organization, okay? Because the last thing you want to have is unwanted attention. Now, I'm going to highlight today 4 scenarios that can lead to a tax audit, okay? So the first scenario is very simply getting reported to the tax authorities, i.e. getting denounced. And in China, guanxi, i.e. the relationship that you have with people can be what brings your growth. But if you do create a bad and damaging relationship where the other party has lost face, this can be extremely damaging to your company, i.e. getting the unwanted attention from any of the government authorities, including the tax authorities, okay? Now, what you want to do is completely avoid this scenario, right? But I also want to highlight where the denouncement can come from. It can come from business partners, it can come from employees, it can come from shareholders, it can come even from your neighbors, that, i.e. the companies that are working next to you, okay? It can come from anybody that is trying to, I don't know, put a bad name to your business, you know, destroy your brand image ultimately. Just as a very simple case study, I mean, we have personally had competitors that have denounced us in Hong Kong, that have denounced us in China based on the services that we market and what is in relation to what is inside our business scope. This is why I am so fundamentally pushing people or emphasizing to companies that the whole stage of incorporation into China, you have to be so detailed in the business, making it as broad as possible, because your competitors can denounce you. And like I said, getting that denouncement, in the end of the day, it didn't affect our business in any shape or form. The services that we were marketing were the services that were in our business scope, but ultimately it caused my time and several of our senior managers to communicate with the authorities, to show our business license, to show even our marketing strategies, how we were marketing, and the actual services that we were providing to clients. We had to provide invoices that we send out to clients, service agreements. I mean, the time spent was just a pain, right? And this was us, somebody denouncing us, right? We have ideas of who it was, but obviously you can never guarantee it because the authorities won't tell you. But anybody could denounce you, okay? Even, like I said, when there's a lack of substantial wrongdoing, all right? And please also keep in mind that I'm talking today about tax audits, but audits can actually come from any government bureau, whether it's from the Ministry of Commerce, whether it's from the State Administration of Foreign Exchange, whether it's from the tax authorities, okay? It can even come, previously, it could even have come from the Labor Bureau, but as I will highlight today, that's even now being consolidated under the tax authorities. So it can come from anywhere, right? So to move on from that, one of the key things to make sure that you have a bulletproof organization, and that's the whole point of the China roadmap methodology, is to make sure that you have contracts in place to secure all of your relationships, whether it's with employees, clients, or partners. And what you say that is written in your business license is what you are actually doing in the Chinese market. One of the biggest mistakes that my clients make is that they don't appoint China-based lawyers to supervise their businesses. They use lawyers that are in their home jurisdiction that have relationships with firms that might be in China. My recommendation, choose your law firm. Choose the firm that you want to represent you by reviewing contracts, drafting contracts, helping you in arbitration situations, whatever it might be, right? Or even just simply in negotiation processes. Make sure you have a China-based lawyer on board that you have chosen. Again, people can recommend you. I mean, I personally work with 2 different law firms in China. I have 10, 12 individuals. Depends on the budget of the client, depends on the communication that they need, what language that might be in. But there are 2 that I predominantly work with that I like, that I've worked with for over 10 years now, and where I've formed also friendships, and that I also trust, and that I also personally use. So, you know, I can make recommendations, but ultimately it's a personal relationship with your lawyer. The same like it's a personal relationship with your accountant. You need to have transparency, you need to have solid communication tools, and you need to be able to just very simply have that open dialogue. So choose a lawyer that will secure the relationships that you are developing, so that in case there is any termination that has to happen, you have a lawyer who's on your side, who can help you with the negotiation process, who can help you avoid any potential liabilities, who, even in cases with senior management, if I would have to fire a senior manager, I would get my lawyer to come in the office with me, so that I have someone who knows the labor law system back to front, and whatever pops up from the other party, I have someone backing me. Okay, it's actually ultimately a protection tool, right? And although that will cost me money, I know that if I have somebody by my side, it will actually reduce my liability, because if I don't have a certain level of knowledge how to terminate these contracts and how to prevent the other party from losing face, that's going to cost me more in the end if I don't have someone on my side who knows everything back to front, right? The other thing that you want to have, so one thing is the contract aspect in terms of those relationships. The second is having clear operational guidelines, and ultimately developing a culture within your own organization on how to properly terminate relationships, so that no party loses face, because that is the key thing. It is very cultural, all right? Someone gets angry at you, they will denounce you, all right? So you want to create a culture in your organization that is above board, where kickbacks are illegal. You want to instill in your staff a certain level of compliance ethics, and then you want to have operational guidelines to supervise that. And by educating your staff, plus having then lawyers on your side, that whenever there's a termination that has to occur in whatever relationship, partnerships, third-party suppliers, clients, or even employees, you have someone on your side who's helping you, okay? And it does start off with the culture you're trying to encourage within your own organization. Now, just as a case study, I had a client back in the day, and on some level this might be a little bit funny, but ultimately it wasn't funny at the time. I had a client in Shenzhen, and they perform very simple assembly. I was not aware that they had gone to that level. When we had actually set up the organization, they were purely a wholesale trader. And internally, they had then set up a very small assembly line, not even a workshop, in their commercial office space, to do pick, pack, labeling. Never changing the type of structure that they needed, but ultimately forgetting that they had to update their business scope. Anyway, lo and behold, they had a very disgruntled employee, to the point where this disgruntled employee one day lost complete face to the management as well as to his colleagues. And he ran around the office with a pair of scissors, threatening to stab people. So I guess we can laugh at that a little bit, but at the time it really wasn't funny. So I actually got a phone call from the GM, who was Dutch, who called me. He locked himself in his office and he told his staff to go under the table. And he said, Christina, what do I do? And I said, you call the police. You hang up with me and you immediately call the police. There's an English hotline throughout China, and you call them to calm down the situation. Because the fact that he's holding a pair of scissors and he's going around the office threatening, it's an act of, you're not safe in any shape or form. So he called the police. He realized he was able to do that on his own, even with the English, and the police came. And they calmed the gentleman down. But what then, the repercussions of all of that was the fact that this employee denounced the company, and denounced them on a variety of different threats. One of them being that they were doing simple assembly and their business scope didn't reflect that. There were other items as well, but this brought on an investigation by the Ministry of Commerce as well as by the tax authorities. and the company was given a time frame in order to be able to update their business scope, which was absolutely fine. They weren't penalized. I mean, the issue was they hadn't informed their corporate service provider, me, that they were doing this. So they didn't have the knowledge level to update it. No penalties arose. They then had to go through a tax audit to make sure that nothing else was non-compliant. And again, nothing was found, but it did cause a disruption within the organization, right? For about a 3-month period where they could not focus on anything else but the audit from the Ministry of Commerce and the audit from the tax authorities. And then the actual culture and morale in the office. Now, ultimately, this employee did get fired. They got a labor lawyer, thankfully, at that point to do the termination. A severance was paid, as is duly Chinese labor regulations. The guy left, okay? But I just want to highlight here, any person that you fire or terminate, they have 90 days to file a complaint from the date of termination, if they want to, all right? So there is this 90-day gap, 3 months, where, you know, if they are unhappy in any way, they could denounce you. So you've got to keep this in mind. But I think this is a perfect case study to show that being denounced to any government bureau, tax authorities, Ministry of Commerce, can occur by anybody in China, okay? It can occur by employees, it can occur by your office neighbor, it can occur by third parties, it can occur by your competitors, it can occur from anyone who wants to cause you trouble, all right? And the goal is, obviously, from this first scenario, is to say, we've got to make sure all of our paperwork we've crossed the T's and dotted the I's, okay? All of our contracts are bulletproof. What we have stated in our incorporation in terms of business scope, capital, whatever, it's all the reality of the situation, okay? So please do keep this in mind in terms of scenario number 1. Scenario number 2 is obviously something we want to completely avoid, because for me, scenario 1, to be quite frank, like I highlighted, it happened to me. Competitor denounced us. We were marketing certain services. The guy didn't believe that was in our business scope, and we got audited. We didn't have to spend 3 months on that case, but it did take up a few weeks of our time in order to be able to justify what we were doing, and we had to provide supporting documentation, which we had. We had service agreements, we had invoices, we had all of that. So from an operational perspective, we had crossed the T's and dotted the I's. Now, red flags in terms of your financial reporting can come in a variety of different formats, okay? And what I'm going to be highlighting in this section is big data, okay? And I'm going to be explaining to you what big data actually means, because it shows how advanced the Chinese tax authorities actually are in order to be able to identify any fraudulent behavior. So in terms of red flags in the financial reports, it can come from a variety of different sources. It can come from your tax reports, so all of your tax declarations, whether it's VAT, corporate income tax, consumption tax, if that applies to you, you know, all the taxes that I highlighted on day 1, right? Plus then also VAT. You've got the financial management reports, so that is your P&L, your balance sheet. Those are the 2 main documents that the tax authorities will look at. Obviously, they may ask for additional supporting documentation, which would then be cash flow statement, trial balance. And then they may even ask for further breakdowns on assets, on just other types of information. Then you've got the fapiaos. So as I highlighted in yesterday's presentation, all of the data, if there's frequent mistakes in the data that you're inputting in the fapiaos, that will be a red flag. Social Security filing. So this is very key because it was actually implemented in 2019, but officially now, October 2020, it is pertaining to every single company in China. The tax authorities are managing the whole social insurance schemes. okay? So that's something that's very, very new. They were doing it previously for larger organizations, and now it's for everybody. And meaning that you pay your social insurances for your staff to the tax authorities, no longer to the labor bureaus, okay? Then you've also got customs clearance if you're trading. And then any other business registration related documents, so business license, everything that is within the unified system. So the unified system means that when you set up your company, your business license was issued by the Ministry of Commerce, but it pertains to 5 different government bureaus, and you have a TIN number, a tax identification number, that is on all of your certificates, and it's what identifies the company, okay? So these are the types of documents and items that the tax bureaus will look at and see whether it identifies any red flags, all right? So to give you an example, I've made a very simple example in relation to individual income tax and corporate income tax and how it's related. So if the tax bureau system recognizes a mismatch of gross salary being recorded between the individual income tax declaration and the corporate income tax declaration, then this is an alert and the tax authorities will begin to investigate. And this happens quite often, particularly if companies are, number one, trying to reduce the individual income tax liability for individuals, or number two, trying to reduce the corporate income tax liability on a quarterly basis. Okay, so what I want to highlight here is that the tax authorities have this internal system that is basically reconciling all of the data against all of the tax reports, all of the financial management reports, all of the fapiao information, all of the customs information. It's all in a system where alerts can be created to your tax officer for your company should anything be mismatching. Okay, so this is where it's really important to make sure that your accountants, particularly if you've got in-house accountants who are, their goal is just to save you tax, but they're not telling you how they're doing that there's this transparency on that. Okay, so in regards to the tax authorities, red flags would be things like repeated or consistent abnormalities in the financial figures, not being able to provide supporting documentation, and any other type of fraudulent activity in the accounting world that you could imagine. And this is where sometimes companies get confused or there's a misunderstanding. But similarly to the Western world, if you are looking at jurisdictions like the UK, Germany, the US, how the tax authorities are working to make sure you're not doing anything fraudulent is exactly how China is doing it, okay? The goal for China, like any other jurisdiction, is to earn tax revenue. That's how they're going to sustain themselves. And this is why they've created the concept of big data. And big data is actually the tax authorities' term for all of the data collection in order to be able to identify red flags or fraudulent activity. And there are 4 ways that the tax authorities do this. One is by reconciliation. So it's data across the multiple reports that are filed with the tax authorities. 2 is comparisons. So looking at your business from different periods. So let's say you're looking at 2018, 2019, 2020, 2021, 2022, looking at the averages, seeing whether there's growth, whether you're retreating, etc. They do this type of comparison year to year, month to month. Then there's a ratio analysis, which is actually benchmarking your company against your sector, your sector's industry figures, i.e. your competitors. And then verification, which is both quantitative and qualitative data, okay, in the tax systems. So I want to give you a couple of examples, very simple examples, in relation to some of these items, okay? And I've just made notes on this so I don't forget all the examples. But the first one in reconciliation would be revenue. So as I highlighted on day one, revenue is paid on a quarterly basis, okay? And as a result of that, many businesses will postpone recognizing their revenue until a later date, purely to lower the corporate income tax liability, right? And this often then exceeds the legal limit, I guess, for accruing their revenue, right? And I can't give you a threshold number, but within the tax authorities, they have this threshold, this legal limit. So through the new e-tax system, the tax authorities know exactly when your client books the fapiao that you gave him. So if you haven't recorded it, but your client has recorded it, that's a red flag. That's a mismatch. Okay? And it just shows that you haven't recorded it because you're trying to lower your profits tax liability. And this leads again to profits, where naturally in the third month, when corporate income tax is due, there's usually sharp increases in costs as well in order to lower the tax liability. So they do all of this type of reconciliation, okay? The same for salaries. Many businesses report inconsistent and often incorrect figures for the salary amounts in the management reports in order to obviously minimize then the individual income tax as well as the Social Security payments, right? But as Social Security is now paid to the tax authorities can reconcile all of the salary figures under the financial management reports, okay? So it's dangerous to be playing around with that in terms of the salaries. For comparison, right? Here, let's just look at a simple comparison like fapiaos. So the tax authorities are monitoring, like I said yesterday, are monitoring not only the value of the fapiaos issued, but also the number of pieces. You are purchasing a fapiao booklet, okay? And VAT fapiaos are closely monitored and controlled with only a limited number of pieces given to every company, right, by default. If you are suddenly purchasing more invoices in a certain period without any explanation for it, that will be a red flag as well, okay? Or you are not issuing fapiaos at the same level that you were used to doing, and you cannot provide supporting information on that, that is also a red flag, all right? Now, in terms of revenue, if there is a really sharp decrease in sales from one period to another, it is likely that the tax authorities will require supporting material for that. So, you know, is it because the company lost a key client? Is it because they have allocated that revenue to another legal entity in another jurisdiction? Okay. What the taxpayers want to verify is, are you trying to push your business outside of China, even though it's done in China, to a tax haven to lower the business? Obviously, in COVID-19, that has had to happen. But if you have the ability to provide the supporting documentation or the reasoning behind why you're doing that, i.e. you need another jurisdiction subsidiary to survive, then they will let you go, okay? In terms of verification, it is very simply that the tax authority can verify information with all government bureaus, as well as banks, as well as other types of companies. So this includes the Ministry of Commerce, Customs, State Administration of Foreign Exchange, banks for not just companies, but banks also for individuals. And they are basically verifying all of this information. So what I want to highlight here, compared to 2003, where there was none of this integration and this digital system available, or these algorithms that were set up, now there are, okay? The tax authorities have really boosted their internal operations to be able to identify everything, and they're using this big data in order to be able to detect whether there's any fraud occurring. And obviously, if they detect anything, you will have to go through a tax audit. So there are 3 questions on what you need to think about when looking at your financials. One is your accountant keeping complete and accurate set of books? Do you have all the necessary supporting information for your transactions? Does the balance sheet reflect a realistic financial position of your company? Okay, these are the 3 questions you really should be asking yourself on a month-to-month basis. And if you have any form of doubt, go into doing a health check or your own internal accounting and tax compliance procedure. Okay, that is the way you are going to know whether you're in good standing or not. All right. So just a case study here. I've written Shanghai Accounting and Corporate Services Company. That was us. Besides the fact that we were denounced by competitors, we were also asked by the tax bureau to do a tax audit. And why? Because our company looked too, I laugh at it still. Our company looked too successful compared to other companies in the sector and in the industry. And they did a ratio analysis, and they did basically a benchmarking and against other corporate service providers within the city of Shanghai. So what we had to do for that tax audit, and again, it involved me, it involved my senior managers, was we had to provide an operational guideline outlining how we did client acquisition, how we did client retention, and what was our billing mechanism, i.e. our service fee mechanism our clients. And they were just actually intrigued by us more than anything else. But that also brought in a tax audit. So even if you might become successful in China and you are more successful than your competitors, it can also lead to a tax audit, okay? i.e. what are you doing that is causing that and nobody else can imitate that, right? So we were above and beyond the benchmarking that they normally do for other corporate service providers. It was a super interesting experience to go through, not something I would love to do again, because it was just time consuming. The amount of meetings we had to have, the number of back and forth questions that we had to go through, and ultimately it was a very quick procedure, but it's still time consuming. I mean, definitely, I was scared, I was worried. So although they were intrigued, that was fantastic, but I was still worried that we had done something wrong, that something wasn't right, that, and they just spring this on you. Well, the tax officer started asking to give us documents. I said, why? It just got into a bit of a rolling effect until finally we had to have face-to-face meetings, and they actually wanted us to go through the actual flow of our client acquisition, our retention, and our billing mechanism. So not the funnest of procedures to go through. Scenario 3 is applying for a tax refund. So, questions I would have for you is, why are you applying for a tax refund? Have you paid too much VAT? If yes, why? Have you paid too much corporate income tax? Again, if yes, why? Okay. Obviously, you have a bunch of other taxes as well where this could occur, but probably the amounts are so minimal compared to what you would be paying for VAT and corporate income tax. Okay. So applying for a tax refund is really not as straightforward as people assume, because for the fact, very simply, that the tax authorities want to earn tax revenue. So if you are now asking for a refund, they are just simply going to investigate that, okay? So you want to be able to make sure and understand exactly why that would be occurring. So when you're applying for a tax refund, right, you just have to know that the corporate income tax is paid quarterly on estimated profits, and the annual corporate income tax clearance is based on the actual profits of that year, okay? So in theory, when it comes to the annual corporate income tax, it should all be leveled out. Like the amounts of whether you have overpaid or underpaid should really be within this minimal threshold range, where you can even say to the tax authorities, give me a tax credit versus asking for a refund. If you're asking for a refund, it's because you have really paid too much, okay? In order to avoid this, you obviously want to have tax planning. You want to have proper financial controlling. You want to be able to minimize your costs in the best way. but you just want to make sure that you remain within that threshold where you just simply have to ask for a tax credit if you've overpaid. If you've underpaid, no issues, you have to pay out the remaining amount, okay? Scenario 4 is the legal entity liquidation in China, and here it is an automatic requirement that a tax audit happens. So if you go through the process of liquidating your company in China, you don't need the entity anymore, there's no more business that is going to be occurring. Just so you know, a liquidation process does take between 18 and 24 months to complete. The tax audit will take approximately 1 year. And the reason for that is that the tax authorities, they will do a complete review of a minimum of the last 3 full years of operation. In some instances, it could even be the last 5 years of operation, okay? When you start the liquidation process, you've got to make sure that you've terminated all of your employees, all assets have been sold off, there's no more accounts payables, no more receivables, basically everything has stopped within the organization. Then you start the liquidation, and then the tax authorities do that full tax audit on minimum the last 3 full years of operation, okay? And the goal of the tax audit is purely to make sure that you have no outstanding tax liabilities under any of the tax categories, whether it's corporate income tax, VAT, social insurance, individual income tax, consumption tax, stamp duty, whatever it might be. So in order to maintain the liquidation, in order to go through the liquidation, it's sometimes advisable to go through a health check prior to that, because what you don't want to go through is a situation like a client of mine that we went through a liquidation process for about fapiaos in the fapiao booklets. And this was a huge issue for the tax authorities, that they were lost. So they received a penalty, and the penalty was that they had to pay 10,000 renminbi per fapiao that was lost. In total, I think the penalty fee was about 150 to 200,000 renminbi, which in the end, one joint venture partner said there's no way we're paying, and the other joint venture partner said we don't have the funds to pay it. As a consequence, the tax audit therefore was halted, and the liquidation went no further. The worst case scenario possible was that the 2 shareholders, their companies were put on a blacklist, meaning that those 2 entities were unable, or still are unable, to incorporate structures in China. So before you start a liquidation process, you want to make sure that your company is in good standing and status quo before starting that you're not going to incur any penalties, that you're not going to incur any great outstanding tax liabilities or anything like that. So sometimes it is advisable to do a quick health check, at least on the last year of operation, to make sure you are in order. Now, one of your questions might be, well, you know, by law in China, we have to complete a year-end audit. So if we complete a year-end audit, why isn't the auditor checking for these things? It depends on how much you want to pay for an auditor. If you go with the very cheap auditors that charge the minimum rate, so if your startup is usually at 5,000 RMB, they're not going to do a very thorough investigation. They're going to look at the basics, and they're going to produce you an audit report that's very, very basic. Obviously, if you go with larger organizations, they're going to do a thorough investigation when they do the audit, and they will bring out things within your organization. So it really will come down to your budget on that in terms of who you choose as your auditor. There's no right or wrong. It really will come down to your budget, okay? But ultimately, you want to make sure then that you have at least an in-house accountant or outsourced provider that is protecting your organization and making sure that they're doing the accounts and the tax declarations properly. So obviously the goal is tax optimization, not tax evasion. And ultimately what we want to do is protect our business, cross all the T's, dot all the I's to make sure that we have the back end administration of our organization bulletproof, so that if we do get approached for a tax audit, it can be swift because you have all of the documentation already there and nothing jumps out as a surprise. Okay, it's purely going through an explanation of how your organization is running. And you need to have that transparency and level of understanding. Now, I have added another section here because there are a lot of companies in China that are now looking for investors or are looking to be acquired. Okay, so although it's not going to be a tax authority that is going to come to you to do an audit, I do want to highlight this because there are a lot of companies in China that are looking for additional investors, that are looking to be acquired, and they don't realize the intensity of that process. And I'm using my own example of this because we did sell our company and we went through this whole process of being audited for the sale process, and it was very stressful. I mean, that doesn't even highlight the amount of stress. It was tough because you have an outside auditor coming in to audit your entire organization from up to down, down to up, left to right, right to left, right? The analysis that they go through on your business, your organization, and ultimately only looking at the numbers, wow, it was a very, very tough procedure. And I've seen a lot of entrepreneurs establish their businesses in China and not place any attention and focus on their finances, on their accounts, okay? They put the full reliance, and I understand why they do that. They do it because their attention is on the core of their business, which is sales, 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 revenue, 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 profit, 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 versus looking at the actual operation and administration of the organization, okay? And like I said, accountants make mistakes. And if accountants don't have guidelines from the owner in terms of how to book certain things or how they want certain things to be booked in different line items, it gets very complicated because these are the tough questions that come up from the auditors of the investors, okay? So place attention. If you are looking at some point to sell your organization or you're just looking to add additional investors, they will only focus on the numbers. And if the numbers during the audit do not reflect the true status of your organization, well, that just lowers your evaluation number for your company, okay? So what is the action plan to avoid a tax audit? So the action plan is obviously avoiding a tax audit altogether. In my case, I've been audited twice in my 17 years, one by the Ministry of Commerce because I was denounced by a competitor, and the other one by the tax audit because I was doing too well in the Chinese market. We want to avoid tax audits to begin with, but if we can't, and there's always an inkling back in, in the back of your mind, then at a minimum, you want all of your administrative processes to be up and running. And again, this reflects back to my China roadmap methodology. It's getting all of those checklists, those operational guidelines, those directives all set up so that you're aware of what your status is. You've got to involve your financial department in this. And I just want to highlight one thing. Finance people in China have zero proactiveness, zero. They will never proactively come up to you. So you need to do that. And you need to do that on a monthly basis so that you understand finances. Produce the monthly financial management reports. So every month you read those reports immediately and you analyze those reports. Rate the questions you like, right? And obviously the goal is to be able to compare that actual financial management report against your budgets that you've created, because you want to raise questions, you want to make I still make adjustments because they sometimes don't put the right things in the right line item or in the right category, right? So on a month-to-month basis, you've got to be able to make those adjustments. That is a true organization. You do have guidelines, but if you don't, with your account basis, that's a really one to your company is in proper standing. I make sure that you go through this very, very carefully, whether it is an internal accountant or whether you're using an external provider, okay? I'm not going to pinpoint anyone out, but it would always be helpful for me to know what you've learned and to have an understanding of whether this presentation has helped. So please do type in what we can help. So we do everything from budget creation, validation, tax advisory, implementation of ERP systems, the full outsourcing or partial outsourcing of accounts, tax, VAT, payroll. We can also help with objectives, and naturally we do health checks and internal accounting and tax compliance reviews. We don't do audits. That question hasn't popped up, but I do want to highlight it. We don't do audits for two reasons. One, being a full 100% foreign invested company, we cannot have the option to get a Chinese joint venture partner to offer that service. And two, I always think it is good to have new, fresh set of eyes going into your books on an annual basis to do your review. If you're budget restricted and you're choosing a local CPA firm with minimal money, don't expect too much from them. Obviously, my recommendation would go with somebody a little bigger that actually does a proper audit on your organization, and that audit is then submitted to the authorities. If you guys are interested in having a chat with me or talking about your own organization, please do. I am going to provide you here with, hold on, the link to my diary. And you can log in and set up an appointment directly in there according to your own schedules and flexibility. There's no strings attached, but if you do need already, we're going to start the Q&A. I would love to start the Q&A, but there are no questions at all that have been, nobody's actually chatted with me today. Sad. But okay, well, if there are no questions, I'm going to keep going. But if you do have questions, just type them because I will be staying online for a little while. Again, if you want to set up a call with me, please go ahead and do that. If you want to connect to our China Roadmap community on WeChat, I'll give you my WeChat ID right now. Just let me know and I'll add you into the community. Otherwise, we've got 2 more sessions. So tomorrow we're going to be talking about internal control systems. So a little bit about creating those operational guidelines. And then on Friday, we're going to be talking about profit repatriation strategies. So if you haven't signed up for those, you can do that today at woodburnglobal.com/events. I want to thank you all so much for joining and participating. And if you've got any questions, I'll stay on for the next 5 minutes or so. Take care and goodbye.